Here we go. Hi, happy Friday, everybody. It is 4 o'clock Eastern time, and the bell just rang. Had a pretty good week this week.
Great week.
Right?
Yeah.
New record highs, not today necessarily, but it was pretty flat today.
You know, the Dow was down today. NASDAQ was up
Barely.
though.
Barely. Had a pretty good week.
Barely down.
Having some good record highs. So that's why we know it is so hard to move forward with something when you don't understand. And it's easy to just kind of give up and say, you know what, I don't understand, so just push it off and do nothing. And that's really, really important that you don't do that when it comes to investing. You know, stocks are something that's very basic way to invest, but some people don't invest in stocks because they don't understand. Now, they're not for everyone, but today we want you to understand stocks, what they are. We'll basically break down exactly what they are, how they make money, what the risk is, what dividends are, how they pay you money, all this good stuff, so that you know you can feel comfortable to make that decision if stocks are right for you on how you want to invest. Because you can't just do nothing. This is how you build wealth. This is how you get ahead, and how you make sure that, you know, you're not just going paycheck to paycheck. So it's important. So we want to help you with that today. We'll cover all the basics on stocks, and then we'll get into some specific companies that we like and why. Just so
Or
you can,
sectors. Maybe one company and then sectors we like.
or both.
But before we get to that, I want to talk about what we talked about last week. We had a debate last week about
ETFs and mutual. The taxation.
taxation on ETFs.
Yes.
Okay, so I called, and Amy doesn't know the result
I am
of
looking
this.
forward to hearing this.
I just got off the phone with a company. I waited all week to check into
ETF
this.
company?
Yes.
An index company. Okay.
So, for those of you who don't know, last week we talked about ETFs and how they're taxed. And the pitch with exchange-traded funds is what we're talking about. Exchange-traded funds versus mutual funds. Mutual funds are actively managed. ETFs typically are not managed. They're more of an index. But not always, because there are some actively traded ETFs.
And if you didn't watch last week, by the way, mutual funds and ETFs, all they are is a diversified basket of investments. So instead of just owning one company or one investment within one ETF or one mutual fund, you may own hundreds. So it's just an easy way to diversify you. You're buying a portfolio of something.
Right.
Okay, go on.
Typically, the fees are lower on ETFs. When we do equity funds, we use equity ETFs, not equity mutual funds.
I'm seeing in the comments RT's asking what you're doing here.
What am I doing here?
He's my sidekick. He's allowed.
Okay, so Amy said that last week. Amy said that ETFs are not. You won't have capital gains distributions like mutual funds. Within a mutual fund, as the manager trades inside the fund, there's capital gains.
And whether you actually sold the mutual fund that year or not,
you could still
get capital gains,
yes.
Whether you're up on the mutual fund or not.
That's the real kick in the pants, is when you're down for the year on the mutual fund.
On the overall value of the mutual fund, but because of the trading within the mutual fund, they sent you a form that you have to pay taxes on.
Right.
Yeah.
So not fun. Not fun at all.
Yes.
So Amy said that there's no capital gains in ETFs. Mm-hmm. And the result is that he said I said that's ridiculous. Of course, if you're going to sell something within an ETF, the IRS is not forgiving, and they just...
What's the answer, Jim?
The answer is, he said we're both right. He said there are times in exchange traded funds where they put a hedge on inside the ETFs. Okay. Certain funds will hedge. There's really no way to get around that. But the reason why you were correct, mm-hmm. I was correct too, though. But
because of the random hedging that they sometimes do within ETFs.
All right, I'll give it.
So it's not a normal practice.
No, but
whereas in mutual funds it is. Okay.
Okay, so to wrap this up, though, but the reason
we need to get on
with an ETF. Let's say within the ETF you want to sell. The manager in the ETF wants to sell Ford and buy Amazon. In a mutual fund, you have to sell Ford, turn it to cash, take that cash, and buy Amazon.
Okay.
In an exchange-traded fund, the market maker will find Amazon holding, and it's almost like a swap.
Oh,
so they don't physically sell. They're just swapping.
So what that means to you?
It's more tax efficient.
It's more tax efficient.
You were more right than I was.
Okay, I love you.
All right.
Can we talk about stocks?
All right, let's get to stocks.
Okay.
All right. How long are?
4 minutes. There's not a clock on there. I was looking over here.
All right.
Okay, so stocks.
Are you happy though? You were more right than me.
I know, honey, but I'm not rubbing it in. Thank you.
I'd rub it in if I was more right than you.
Well, I knew I was right, so it's not really shocking.
I don't think you did, because I think you were a little nervous.
Honey, I wasn't.
Well, all right, let's move on.
So stocks, what they are is they are a unit of ownership of a company. So they're a way to measure the value of a company. So you're not part owner of the company. You know, if they're going to sell assets of the company, you're not going to get a piece of that. You know, like you're not part owner, but you are part owner of the unit that represents the value of the company. So when you see a stock worth, $100, however many shares they have out there in the universe, on the exchange, trading, whatever you want to call it, that number multiplied by the value of the stock per share is the value of the company. So the reason why this is important to you is for two reasons. So first of all, if you buy a stock at 100 and the value of the company goes up, you make money. So if you buy it at 100 and it goes to 110, you just made 10% on your money. Okay? Very easy to make money. I mean, this can happen in a day, this can happen in an hour, depending on what's going on. This can happen in a year. You never know. So it's easy to make money in a stock when you're thinking of it that way, right?
It's also easy to lose money in a stock.
I was right there. You took the words out of my mouth.
Oh, very good.
Because it could just as easily go backwards, go down, right? So when you're talking about the value of the company, you need to look at the reasons why the company might go up or might go down, or bankrupt.
What's a reason not to buy a stock? What are some of the crazy things that come up where people call and say, well, this is why we should buy it?
They're about to get a contract. Rumors. I think that's probably a big thing.
Yeah.
We get calls all the time, like rumors, like they're about to get this and they're about to get that.
Or I saw on TV that
they're doing this.
Well, by the time it's on TV, everyone knows about it.
Or every time I walk in the store, it's busy.
You said that. We talked about this a little bit. You had made the statement, the Amazon story, and how
everybody's
uses
kind of
Amazon.
jumping on the Amazon.
But that is,
right.
I was gonna say, I saved it for the call that I didn't disagree with you in the office. I wanted to save it now because
you keep calling this a call. By the way, it's not a call.
We're using a phone to record it.
Okay. Hi, Marcy. Okay.
Well, I wasn't done.
All right.
Now I forgot what I was going to say. Peter Lynch, Fidelity fund manager, managed the biggest, I think it was the Magellan Fund in the 90s, I think. I'm old. Peter Lynch, his whole philosophy of picking stocks was see what people are doing and what they're wearing and where they're going, and that's what he bought. And
but today with social media and reporting and everything, there's so much information out there now.
Right.
You don't have to pick stocks that way. That's my argument.
No, but at your most basic level, if people like McDonald's,
right,
then people are going to buy McDonald's, and McDonald's is going to have good earnings.
Okay, so you bring up a point. Yes, you are old, RT says.
Not as old as you, RT.
I knew that was coming. You walked right into that, honey.
Yeah.
That brings me to growth versus value stocks. Let's talk about that for a minute. So there's two general groups of stocks, or schools of thought, I suppose you could call it, on stocks. The growth versus the value. So when companies make money, they have a choice to either pump the money back in the company and invest in the company, or they can pay their owners of the stock, so in the form of a dividend. That's what dividends are. Okay, all that is the earnings of the company, and it's the piece that they're not pumping back in the company. They're choosing to pay you, the investor, the stockholder.
I just read something about this yesterday on growth versus value. Over the last value outperformed growth over the last 5 years, but growth year to date is killing.
So growth are the companies that pump the money back in the company. They're growing the company. So when they make money, they're putting it back in the company to grow the company. Okay, they don't have dividends really. Very little dividends if they do. So the value companies are the ones that are kind of established companies, which is what made me think of it because you talked about McDonald's. Like that's a value company, you know. I mean, they're established. They're worldwide, you know. I mean, they obviously can grow, but that's not their ultimate goal. Their ultimate goal is to at least maintain, and they have dividends. So they like to pay shareholders dividends to keep you happy as an investor. So when we're talking today, for those of you that have just joined, about how to make money in stock, you know, it's so easy to do nothing when you don't understand. So we're breaking down stocks, how they make money, what their risks are. Obviously there's risks, and then some stocks that we like. But you're not saying we like McDonald's. You were just using that as an example.
I don't dislike McDonald's, but I actually, it's kind of a coincidence that we're talking about McDonald's, but we did trim McDonald's this week.
Yeah, so I mean...
Sold half the position because year to date McDonald's is up, I think, over 30%.
Let's see.
31%. 31% year to date.
Yeah.
So it's very prudent when you're up 31% in 10 months or 9 months.
9 months.
That you take half the money off the table. I mean, that's a win. You're never going to get hurt buying stocks if you're selling on the way up.
And taking gains, I mean, you got to reevaluate your tax situation when you take gains. When you make money in stock, by the way, you pay taxes on that if it's not in an IRA account. So there's a lot going on here, but we want you to understand the basics of stocks, and we don't want you to just avoid things because you don't understand. So this is, you know, part of a series that we do to educate you, so you at least know, you know, your ins and outs and what works for you and what doesn't work for you. So stocks may or may not work for you. This isn't necessarily recommendations. This is just for your information, but it's just good for you to understand. So growth versus value, we talk about that.
And you didn't let me finish. I said that value beat growth over the last 5 years.
Yes.
But growth outperformed over 10 years, 3 years, year to date, and 1 year. So growth, clearly, at least right now, we want to be in growth, not value, because there's companies like General Mills.
Yeah. Procter & Gamble.
Oh, I wrote a couple of them. Kellogg.
Pfizer.
Oh, Pfizer's actually, well, no, I wouldn't. I don't know. I don't know if I'd consider, maybe not
Pfizer's
Pfizer.
Value.
It's a dividend payer, but they're talking about acquiring Bristol Myers.
Yeah.
So
you see, they
like
walk
Campbell
this fine
Soup.
line, and you don't have to pick a strategy. You don't have to say, "Oh, I'm going to buy only growth stocks." It's good to understand the difference. It's good to understand why, when you buy a company, if they have dividends, or if their plan is to keep their dividends or to increase their dividends. You know, like look at the history of the dividends. That's another good way to find if they're a value company. You know, go over the history of the dividends. What's the site that shows? Is it just dividends.com? Dividend.com? Dividend Channel.
That's it.
Dividendchannel.com.
Yeah.
Shows a really good history of the dividends over time on companies. So you can see if they've increased their dividend consistently, you know, if they've decreased their dividend. This is a great way if you're looking for dividends to buy dividend paying stock. Look at the history. I mean, it's not guaranteed moving forward, but it helps to know the history.
It's good to know the dividend, but as of right now, I would say those dividend type companies haven't done very well this year. And the reason is, it's so ironic.
It's not that they haven't done well. They haven't done as well as growth.
They haven't done well. Campbell Soup is down like 14% year to date.
Okay, well, some
Kellogg is
specific
down
examples.
10. I mean,
Yeah.
it's kind of ironic.
I just meant as an index. It's not like it's getting hammered, but some specific stocks, yeah.
Well, they're lagging because when you're looking at companies like General Mills and Kellogg and Campbell Soup and Coke and companies like that, you would think those are safe, so you'd want to put your money in safe companies that pay a dividend.
Yeah.
The problem is earnings have been so strong that when earnings are good, people go to growth
move
companies.
out of those companies and
So
go to growth.
yeah, money's moving to growth and away from the safer stuff because they want to grow.
And you know, the other thing is that if a safe interest rate, a safe investment, so like treasury bonds, for instance, the 10-year investment, 10-year treasury bond is paying 2.36%. 2.36% for a 10-year investment. So if you're going to have to hold something 10 years, 3M. Oh, 3M. Johnny was asking about 3M.
Oh.
Did well over the last 5 years, really well.
You know what? I will have to get back to you on that specifically. It's a dividend
They have
payer.
a good dividend.
It's not on our playbook, so that's not one that I follow.
We use filters to find certain criteria that we like in companies, and 3M doesn't fall on that radar. But we'll get back to you on that, Johnny, because I do know they've done well, and they do have a great dividend.
And actually, I think it's overvalued. I think because I flirted with adding that within the last 9 months, and I think it appears to be overvalued.
That's why.
Yeah.
So let's talk about that right there, the overvalued. So what he is, break that down for a minute. Like, I mean, one way to look at overvalued versus valued is the PE ratio.
The price to earnings ratio. Mm-hmm. Yeah, so the price to earnings ratio is a very simple indicator that'll tell you exactly.
And you can look it up. I mean, it's public.
Right. And it's a good way to determine if a stock is overvalued or undervalued or valued just right. So
in comparison to other companies in their same market. So, you don't want to look at the multiple of like Netflix and compare it to the multiple of like Johnson & Johnson.
Right.
Two totally different sectors. But if you're looking within a sector, it's good to compare that multiple to other companies in the sector to see if they're overpriced or not. So explain like what overpriced would be.
Well,
or overvalued. You're talking about overvalued. So maybe
you mentioned Netflix.
Yeah.
The price to earnings multiple on Netflix is 113, which is pretty high because I think the average PE on the S&P is like 21.
I was going to say 20.
Yeah, good. So somewhere in that ballpark is
we're
the
not
S&P
arguing.
500.
That's good.
I know, we're doing all right. Yeah. So, but Netflix is 113. Now, the one thing you need to consider, because Netflix has done very, very, very well this year, the one thing you need to consider when you're looking at the PE or how expensive a stock is, you have to consider the growth rates. And Netflix is growing by leaps and bounds.
Which you can also look up, by the way.
Right.
Just Google it.
Just Google it. Just Google anything, really.
Google's so good.
So if you have a high PE, that could be offset by an equally high growth rate, and then it'll really justify why you're paying up for a stock.
So we're getting into a lot of technical stuff, and we'll get into more companies and more information. But let's summarize real quick what we've talked about. So we're talking about the ins and outs of stocks because we don't want you to do nothing just because you don't understand something. We want you to at least make an educated decision, because investing can make you money. It can help you build wealth. And then not investing is a risk, and even in investing there's risks, but you have to go outside of just leaving all money in cash all the time if you want to build wealth. So we're trying to help you do that. Now, with that said, we have covered what a stock is, just a unit of value of a company, so it's a representation of the value of a company, and you own a unit of that. And then in exchange for that, you can either make money in the stock by buying it and watching it go up and selling it. I mean, the risk is it could also go down, so you gotta learn to evaluate stocks, which is what we're talking about now. But also they pay you dividends. If they don't reinvest the money in the company, they can pay you out dividends. So that's just summarizes real quick kind of what we've talked about so far. And moving forward, we're talking about how to evaluate those stocks and some companies that we like and why. You're talking about Netflix and how their PE ratio is very high, their price to earnings ratio. So essentially, the price to earnings ratio is for every dollar of price that you pay, how much in earnings does the stock get, essentially. So, or wait, no. How much are you paying for every dollar of earnings? There we go.
There you go.
How much are you paying in price for every dollar of earnings? So it's essentially telling you if you're overpaying for a stock or underpaying for a stock. And there's always a growth buffer in there. You're always trying to predict the growth of the company, and that's always kind of factored in there too. So that's what he was just saying, is looking up growth rates on companies. So this is different things that you can just look at. In addition to, we mentioned the dividend channel for looking up dividends and the dividend history on a company. And some of the, I don't know if we want to get into too many specific indicators, but why don't we'll go over some sectors that we like now too, because we'll talk about some companies and some sectors that we like. You have a whole bunch of notes written down. Like, look at this.
What? I'm prepared.
You prepare for this? You don't prepare for our podcast, really? I ask you to. I prepare for the podcast. Like, the podcast is different. Hi, Kim. I got to call you back, by the way.
So, sectors we like. Financials. Why don't you explain briefly, why financials are going to be attractive? Am I capable of doing briefly? No, and we're already at 20 minutes, so I want to wrap this up within the next few minutes.
Okay, so when rates go up, banks make money. How simple is that?
It's that simple.
So when rates go up, because they lend out money, And they're paying you how much? Everybody answer the question.
Next to nothing.
Next to nothing, right? Is what they're paying you.
For your savings account.
As rates go up, they're lending it out at higher and higher rates. They make the spread, right? Yeah. So as rates go up, banks usually do well as long as they're in good shape, you know? So we like banks. We like financials. We even like regional banks. So there's ETFs out there that we like. The QABA is regional banks.
It hasn't done very well this year, though.
Not year to date because interest rates haven't gone up as much as people once thought.
The XLF is the bigger...
These are longer term things that we're looking at for at least this specific purpose. But banks and regional banks, for the longer term, and I think 3+ years.
Yeah, companies like...
frame.
Yeah, some of the banks we like,
it,
JP Morgan, Chase.
Yep. So,
Citibank, Bank of America.
Did you just say you like Citi?
Yeah. Maybe the biggest potential growth bank that there is. You want to put a bet on Citibank over the next year? Are you kidding me? You pick another financial and
we'll put them up against each other?
Yeah. Let's do that. That'd be fun. I'm taking Citi. You can have anybody else. Has to be a bank.
Oh, I like that challenge.
Do it.
Right now, off the top of my head?
I would pick JP Morgan if I was you.
Can I pick an ETF?
No, you know what? I'd probably pick Bank of America.
It has to be an individual company?
Yeah.
You pick. I was going to take. No, you can't do that now because I was going to say Bank of America. So you said Citi.
I'm telling you, I would take Bank of America.
That's what I would say.
All right, good.
As
Citi
much as
versus
I'm
Bank
not
of America.
a fan necessarily.
Yeah, I'm not a big fan of Bank of America or Citi for that matter, but
unfortunately, they're going to be profitable when rates go up.
So anyway, we'll write that down. Financials,
we'll write that down.
Aerospace and defense, another sector we like. Yeah. Companies like Raytheon,
I agree with him
Boeing, General Dynamics,
Lockheed
Martin is one of our top 3 holding. That's one of our biggest holdings, maybe number 2 at Nova. So we love Lockheed Martin. Good dividend, super company.
Again, these are not recommendations. Please don't go out and buy all these. You have to understand that this is information for you to establish a baseline for you. You know yourself, your financial situation. If you want us to help you, you obviously have to reach out to us, which I don't think we've said once. What our website is. NovaWealthManagement.com. We're so bad at that, promoting the whole social media thing. But NovaWealthManagement.com. Or we have like tips on our YouTube channel.
Yeah, we got a new website. Go look at the new website.
I like it a lot.
Yeah.
So let's summarize real quick because we are going over. So the basics of stocks, defining a stock, it represents the value of a company. So when you're buying a stock, you're buying something that represents the value of the company. So if you think the value of the company is going to go up, you like to buy the stock, okay? For long term, for short term, whatever, there's day traders that trade within an hour, within a day. We don't do that here, but there's people that make money that way. So you have to, that's what I mean. You have to find the strategy that works for you. And stocks are a part of that a large part of the time. And they pay dividends. So a lot of people, all they do is buy dividend payers. And sometimes companies not only increase dividends, but they'll do what they call stock splits. So they'll split the company so the price goes down, but they increase the number of shares they have out there, trading. And then you have double the amount of shares, and then you get more dividends. So over the long term, dividends can be a great strategy for some people that like dividends. You have to understand that companies that reinvest their money in their company are going for an increase in price.
What I was just thinking about? Like,
hold on 1 minute. Companies that pay dividends want to focus on increasing their dividends. Yes, Jim.
I was gonna try to make fun of you, but then I was gonna tell them that she could see me. Like when we're looking she sees me because I would be over here like this if I didn't, because she's looking this way, but she could see me.
It's very cute. Exit strategy.
Yep.
Exit strategy. That's very good. How do you exit a stock? How do you know when to exit a stock?
No,
that's a whole nother.
He's saying, how do we exit your conclusion is what he's saying.
No, he's not.
Oh, yeah.
Clarify. No, he's asking an exit strategy when you buy a stock.
Yeah,
which is a whole nother video, I think, on exit strategies because there's a lot of different things. But quickly.
Well, real quick, just have a number in your head. If you want to make 20% and it's running, you got to at least take half off the table like we did with McDonald's this week. Mm-hmm. It was up 31% year to date.
At least take half or put in a stop loss. We talked about stop losses. Did we do that?
Trailing stops, I think we did.
I did. I was by myself on that one. That's another Finance Friday. If you don't know what a stop loss is, we went over stop losses on one of the other videos.
But we'll go through that again another time.
Yeah, but you could put in a stop loss. So if you have just have a specific number in your head, you know. So if your goal is really just moderate growth, you can even put a lower number on it, like 10%. You know, you don't have to go with something crazy because it may never get there, especially if it's a dividend payer. So if it's a dividend payer, you got to have lower expectations on the growth of the price lower versus a growth company, because then they're going for the growth of the price, okay? So it depends on the type of company that you're talking about, but overall, the basic is have a number and stick to it. You know, take the emotion out of it so that you're not constantly analyzing, oh, so should I get out now? That's how you lose money.
All right, so in summary, you were more right than me on the ETF taxable question.
Yes.
I'm admitting that.
And I'm not shocked. That sounded really cocky. I just wasn't shocked. It's just a fact.
But you couldn't explain why.
I couldn't explain why. You're right.
So
I just knew that.
All right. And we have a new bet out there: Citibank versus Bank of America
over
between
when?
today.
12 months?
Sure, 12 months. Boy, that's going to be a long bet. I'll write it down. We'll remember. So check out our new website at novawealthmanagement.com. We are on YouTube.
We are on YouTube at Nova Wealth Management. And Twitter at Nova Wealth Management, but management is abbreviated, MGMT, Nova Wealth Management. You can follow us there. And then we also have our individual Twitter pages, but I'm probably tweeting all the time on my individual page. I'm trying to.
Good for you.
But one more quick thing on the exit strategy I just want to mention real quick. This is, everybody, we're wrapping up so people are leaving, but when you try to pick your number and you're trying to stick to it, have a number on the downside too. So have a number both on the gain and the downside, because that will help you. If you can't get emotional if you say, I'm getting out if this stock falls 10%, or buy more. I don't know if that paused it or not. My battery's dying. Or to buy more if it falls 10%. So what you could do is you could have, if it falls 10%, I'm going to buy more. If it falls 20, I'm getting out. You know, something like that. That's an example of, on some equities, what we do. It also depends on what's going on with the company. You know, sometimes they're more volatile, they're crazy, and other times they're very consistent. So if they're consistent, Jim.
You were wrapping up like 6 minutes ago.
All right. I just wanted to mention that. Don't just do it on the upside.
She's got
Exit
a lot
on the downside
to say.
too. Don't just hang on to it and let it fall forever.
What else?
Nothing.
Are you sure?
Yep.
Are you sure?
Thank you for joining, and
we'll see you next week.
I'll see you next week.